Okay, stop what you are doing for 1 second. Did you see what the market just did today? It did not dip. It puked hard. Dow down about 1.76%, S&P down about 2.06%, Nasdaq down about 2.39%, Russell down about 1.21%, and volatility, VIX, jumped about 7.5% to around 20. That is the sound of professional money managers suddenly remembering what fear tastes like. That is not a normal Tuesday. That is, something is shifting underneath the floorboards. And here is the part most people miss. The tremor might not be coming from New York. It might be coming from Tokyo. Because Japan, quiet, polite, sleepy Japan, still sits on one of the biggest financial pressure valves on Earth. And when Japan turns that valve, the entire world's pricing system starts coughing. Let me explain this like we are standing on the trading floor together, watching screens flash red, and someone just dropped a glass of espresso on the risk dashboard. This episode is about why Japan's rates matter so much that they can keep American stock valuations high, and why a Japan rate shock can help trigger global chaos right when a trade war shock is already in the air. And yes, today's volatility spike is exactly the kind of early warning siren traders hate, because it feels like the beginning of a longer movie. So buckle up. Picture this: Tokyo, early 1990. The late 80s bubble is still warm in the air. Real estate worth fantasy numbers, stocks priced like gravity was canceled. Then, reality shows up with a baseball bat. The Nikkei cracks. Banks wobble. Families realize their safe savings were sitting on an asset volcano. And here's the twist. Japan's central bank didn't swoop in like a superhero. It tightened into the mania. Rates were pushed up hard to puncture the bubble. And only later did Japan slide into years of policy whiplash. Cuts, stimulus, deflation, and the long, slow, lost decade vibe that became a cautionary tale for the entire planet. Now fast forward to today, 2026, when Japan is suddenly the main character again, not because of nostalgia, but because Japan has started lifting rates and letting yields rise in a world that was basically built on the assumption that Japan would keep money cheap forever. And when that assumption breaks, it doesn't just change Japan, it changes the math of everything. Here is the core idea, in plain language. Japan has been the world's low-rate anchor for decades. When Japan keeps interest rates near zero, it creates a giant financial incentive. Borrow yen cheaply, swap it into dollars, and buy higher-yielding stuff, like U.S. Treasuries, corporate bonds, mortgage-backed bonds, even stocks, even private credit, even whatever weird carry trade the hedge fund crowd is cooking this week. That's the carry trade. Cheap funding in yen, higher returns somewhere else. Pocket the spread. And when enough money does that for long enough, it pushes down yields outside Japan and pushes up prices outside Japan. Translation: it helps keep American borrowing costs lower than they otherwise would be, and it can help keep American stock valuations higher than they otherwise would be. Because valuations are just a fancy way of saying, what discount rate are we using to price the future? If global capital demand helps keep U.S. yields lower, the discount rate stays lower, and stocks, especially long-duration growth stocks, can float higher. That's why Japan matters, not because it is exotic, because it is a massive engine of global savings and global bond flows. Japan's government bond market is enormous. Japan's domestic savings base is enormous. Japan's institutions, banks, insurers, pensions, are enormous. And Japan's investors are major players in global fixed income, including U.S. Treasuries. So when Japan raises rates, it can start pulling money back home, or at least change the incentive to keep money abroad. And that's where the tremors start. Now let's connect the dots to what is happening right now. Japan's central bank has been moving away from the ultra-easy policy era. Rates that were pinned at the floor for years are rising. Yields on Japanese government bonds have been climbing. And that matters because fixed income is not a sideshow. It's the main event. Globally, the bond market is gigantic. Think on the order of $100+ trillion of outstanding debt securities worldwide. That's bigger than the global stock market in many measures, and it is the foundation under mortgages, corporate borrowing, government budgets, and basically everything that uses the word interest. So if Japan, one of the biggest pools of money on Earth, starts repricing its own bonds higher, that's like changing the gravity setting in the financial video game. And today, with markets already nervous, that kind of gravity change hits harder. Here is the mechanism. Watch how clean the chain reaction is. Step 1. Japan raises rates and yields rise. Step 2. The yen funding is not as free anymore, and hedging costs can change. Step 3. the carry trade becomes less juicy or more dangerous, or both. Step 4. Some investors reduce leverage, unwind positions, and move funds into safer or domestic assets. Step 5. That selling pressure can show up in U.S. Treasuries and global risk assets. Step 6. U.S. yields rise, financial conditions tighten, equity valuations compress, and volatility spikes. That is the movie. And the worst part? It can happen fast because leveraged trades unwind faster than they build. A carry trade is a staircase up and an elevator down. Now layer trade war risk on top of that, because trade war risk is not just about politics. It's about inflation expectations, supply chains, profit margins, retaliation risk, and uncertainty. Uncertainty that forces investors to demand a higher risk premium. And a higher risk premium is basically the market's way of saying, pay me more to hold this. If tariffs or trade retaliation push up import prices, that can keep inflation sticky. If inflation stays sticky, central banks are less able to cut. If central banks are less able to cut, yields stay higher. If yields stay higher while Japan is also tightening, then the global discount rate rises from two directions at once. That is how you get a valuation squeeze. And that is why Japan rates and trade war can rhyme, even if they are not the same story. Are they always directly connected? No. Sometimes they just collide at the same time. But when they do collide, the market feels it as a single combined stress event, higher yields plus higher uncertainty. And today's volatility spike, the VIX jump, fits the vibe of that collision. Because volatility is not just fear. Volatility is the price of uncertainty, and the market just raised the price tag. Now let's do the why Japan is so important section properly, because this is the part that separates casual finance commentary from, oh, I get it now. Japan's public debt stock is massive, and Japan's government bond market is one of the biggest on the planet. Japan also has huge pools of institutional capital, pensions, insurers, banks, that must allocate across assets. And Japan has been a major foreign holder of U.S. treasuries for a long time, meaning Japan is not just watching the U.S. bond market, it is participating in it. So when Japan's yield curve shifts upward, Japanese investors can reassess global allocations. Do we still need to reach for yield overseas, or can we finally get paid at home with less currency risk? That question alone can move flows. And remember, fixed income is about marginal buyers. Prices are set at the margin. You don't need everyone to sell treasuries. You need enough selling or reduced buying at the margin to move yields. And then the yield move ripples into everything priced off treasuries, mortgages, investment-grade credit, high yield, private credit benchmarks, equity discount rates, tech valuations, venture funding, and all the fragile stuff that grew up in the low-rate era. So even a Japan shift that seems small in rate terms can be big in global pricing terms, because it's not just a rate, it's a regime change. Now, let's talk about the carry trade like a human being, not like a textbook. Imagine you can borrow money at basically nothing, because Japan kept rates ultra low for years, and you can buy U.S. assets that yield a lot more. You do that with leverage. You hedge some currency risk. You collect the spread. You feel like a genius, until the funding currency moves against you, or the yield differential changes, or volatility spikes, and your broker says, hey buddy, margin call. And that's when the selling starts. And that selling can become self-reinforcing, because selling pushes prices down, which triggers more risk controls, which triggers more selling. That's how markets go from calm to puking in a day. Sound familiar? Now let's thread this back to today's market puke. Stocks down across the board, risk-off vibe, volatility up, and if you are a trader watching this, you're asking one question. Is this just a bad day, or is this the start of the unwind? Because if it's the start of the unwind, Japan matters a lot more than people think. Now let's address the Japan rate story directly. Japan's central bank has been nudging policy away from emergency mode. That includes rate hikes and letting bond yields breathe more than they used to. Markets have reacted sharply at times, because so many global strategies implicitly assumed Japan would always be the cheapest funding source on Earth. When that assumption gets questioned, positioning gets questioned, and positioning is what breaks first. Now, trade war. Tariffs and retaliation threats create the kind of macro fog that markets hate. It's not just prices go up. It's who eats the cost, which industries get hit, which countries retaliate, what supply chains get rerouted, what corporate guidance gets pulled, and what central banks are forced to do if inflation flares again. That's why trade war headlines can move markets even before the economic data changes. Markets trade the future. Headlines are future-shaped. So here's the blended narrative, without forcing it. Japan's rising rates and rising yields can tighten global financial conditions by pressuring the carry trade and shifting global bond flows. Trade war escalation can tighten global financial conditions by increasing uncertainty and potentially keeping inflation sticky. Put them together and you get a double squeeze: higher discount rates and higher risk premiums. That combo is how you crack valuations. That combo is how you turn a normal correction into something uglier. And that's why today's volatility spike matters. It's the market whispering, "We are repricing risk." Now let's make this real for you, the viewer, because you're not running a hedge fund. You're trying to not get wrecked. When US yields rise, your mortgage rate doesn't care whether the reason was Japan or tariffs or aliens. It just rises. When yields rise, corporate borrowing costs rise. Buybacks slow. CapEx gets delayed. Valuations compress. And the most expensive parts of the market, big growth, long-duration tech, feel it first because their cash flows are far out in the future, and the discount rate is the knife. Higher discount rate equals lower present value. That is not ideology, that is math. Now here's the dark joke. For years, the world has basically been addicted to cheap money somewhere. When the US tightens, people look for the next cheap funding source. Japan was the legendary cheap funding source. If Japan stops being cheap, the world has to sober up. That's when people start panicking, because sobriety comes with withdrawals. So why does Japan keep American valuations high when rates are low? Because persistent demand for higher-yielding foreign assets, funded by ultra-low yen rates, can contribute to lower global yields and more liquidity flowing into risk assets. Lower yields support higher equity multiples because investors accept less return for safe assets, so they pay more for growth assets. Also, when global savings seek yield, spreads compress and financial conditions loosen. That looseness is rocket fuel for valuations, and Japan has been a meaningful part of that global savings flow. Now, what happens when Japan flips the script? If Japanese yields rise and the yen strengthens, carry trades can unwind and capital can repatriate. Even the anticipation of that can cause de-risking. That can push US yields higher and pressure stocks. And if this is happening while trade war headlines are stoking inflation risk and uncertainty, the market can get hit from both sides. That's the multi-front vibe traders fear. Let's also talk about scale, because scale is the entire story here. Global fixed income is vast, massive outstanding debt securities worldwide. Japan's government bond stock alone is gigantic, and Japan is a major foreign holder of US treasuries. So Japan is not a footnote. Japan is a pillar. And when a pillar shifts, the building creaks. Now let's bring it home. What should you watch next? Number 1. Japan policy signals, rate path, language, and how aggressively the market tests JGB yields. Number 2. The yen, because the yen is the funding currency heartbeat. Number 3. US Treasury yields, especially the 10-year and the long bond, because those are the discount rate engines for valuations. Number 4. Volatility, VIX, because sustained elevation means the market is paying up for protection, and that often means positioning is stressed. Number 5. Trade war headlines, because they can shift inflation expectations and corporate guidance fast. If you see yen strengthening fast, US yields rising, and volatility staying bid, that's when you should treat dip buying like a hazardous sport, like wear a helmet. Now, I'm not saying this is guaranteed meltdown. Markets can stabilize, policymakers can soothe, positioning can reset. But today's puke and that volatility spike are telling you something. The market is suddenly aware that Japan is not asleep anymore. And if Japan is awake, the carry trade is awake. If the carry trade is awake, leverage is awake. And when leverage wakes up, it sometimes screams. So here's the big takeaway. Japan's rates matter because Japan has been a decades-long source of cheap funding and massive bond flows. Those flows help support global asset prices, including US valuations, by keeping yields lower and liquidity conditions easier than they otherwise would be. When Japan raises rates and yields climb, that support can weaken or reverse. Add trade war uncertainty and tariff-driven inflation risk, and you have a recipe for higher discount rates and higher risk premiums at the same time. That's how you get days like today. If you want more of these breakdowns, the stuff that actually moves portfolios, subscribe to TWSC, the Wall Street channel, and hit the bell. Because the next chapter in this story will not be announced politely. It will show up in the bond market first, and then it will punch equities in the face. Stay sharp. What are your reactions? Are you worried about markets in Japan or the tariffs? Write a comment and let us know.